Okay, so you want to own a bank. Picture it. Your name, or better yet, some solid, trustworthy name like First National or Heritage Trust, carved into stone above a set of tall glass doors on the nicest corner in town. Inside, the air is cool and quiet. There's marble on the floor and a low hum of respectability in the air. People come to you to borrow money for their first house, their first truck, their first shot at a small business. And you say yes, or you say no, and either way you're the one holding the pen. Money flows in from 1,000 checking accounts, sits in your care, and quietly earns you a spread while you sleep. You're a pillar of the community. You golf with the mayor. You are, in the oldest and most literal sense of the word, the house. And the house always wins. That's the picture. That's what the movies and the old bank buildings and every monopoly board you ever played on have sold you. The banker as the calm center of the whole economy, gently taking a cut of everything that moves. Here's the problem. Almost none of that is where the money actually comes from, and most of what you just imagined is a liability, not an asset. Those deposits sitting in your care? You owe every dollar of that back, on demand, to people who can ask for it all at once. That beautiful marble branch? It's one of the most expensive and least profitable things you own. And the always wins part? Tell that to the roughly 500 and something U.S. banks that have failed since the year 2000, according to the Federal Deposit Insurance Corporation, the FDIC, the government agency that insures your deposits and, when a bank dies, shows up on a Friday afternoon to bury it before Monday. So let me reframe the whole thing right now, and I want you to sit with it. A bank is not really a money business. It's a trust and leverage business that happens to have money passing through it. The money is the product. Trust is the factory, and leverage is the machine that turns a thin little margin into either a fortune or a crater. By the end of this, you'll understand exactly what it costs to open the doors, why the deposits you think of as your treasure are actually your debt, how a bank really makes money in 4 distinct layers, why the single most boring risk in finance, interest rates, is the thing that quietly kills more banks than fraud and robbery combined, and why the smartest owners of banks aren't chasing the interest at all. They're chasing something else entirely, and we'll do it with a real bank, a famous one, that went from Silicon Valley darling to the second biggest bank failure in American history in the span of about 48 hours. But before we talk about money, we need to talk about what a bank actually is. Because a bank is not one thing. It's a category pretending to be a single object, and inside that category are businesses that barely resemble each other. Some are community banks, small, local, usually under $1 billion in assets, making loans to farmers and dentists and the guy opening a second pizza place. Some are regional banks, running across a few states, doing commercial real estate and mid-sized business lending, the kind of names you half recognize. And some are the money center giants, JP Morgan Chase, Bank of America, Citigroup, global animals that do trading, credit cards, investment banking, and derivatives, where taking your deposit is almost an afterthought. Then, off to the side, you've got credit unions, which are technically not-for-profit and owned by their members, and industrial loan companies, and online-only banks with no branches at all. Here's the thing. These are not the same business wearing different sizes of the same suit. A community bank lives or dies on relationships and local real estate. A money center bank lives or dies on trading desks and capital markets. Calling both of them a bank is like calling a food truck and a cruise ship both restaurants. Technically true. Completely useless. So for this whole video, we're going to focus on the one most people actually mean when they fantasize about owning a bank, the community and small regional commercial bank. The one with the marble floor. The one you could, in theory, actually start or buy. Because that's the dream. And that's where the trap is best hidden. Let's talk about the first wall you hit. Entry cost. You cannot simply buy a bank the way you buy a laundromat. A bank requires a charter, legal permission to exist, granted either by a state banking regulator or, at the national level, by the Office of the Comptroller of the Currency, the OCC, another federal agency. And to get one, you need capital. Not revenue, not a loan, capital, meaning real money that the owners put in and that belongs to the bank as a cushion against losses. Starting a brand new bank from scratch The industry calls this a de novo bank, which is just Latin for from new. Regulators generally want to see somewhere in the range of $20 to $30 million in starting capital, and for anything beyond a tiny single branch operation it often runs higher, 30 to 50 million and up. And that's just to satisfy the regulators that you can absorb early losses. That number isn't your building, your staff, or your marketing. It's the pile of money that sits there specifically so that when things go wrong, and they will, you don't instantly go under. If you'd rather buy an existing bank instead of building one, the price is usually quoted as a multiple of its book value being, roughly, its assets minus its liabilities, the bank's actual net worth on paper. Healthy community banks trade somewhere around 1 to 1.5 times book value, sometimes more when they're prized, less when they're troubled. So a small bank with 15 million in book value might sell for 15 to 20-something million dollars, on top of which you inherit every loan on its books, good and bad. And here's the lesson that people miss at exactly this moment. The price of the bank and the profitability of the bank are two completely different numbers. You can buy a bank cheaply precisely because it's about to cost you a fortune, bad loans, aging technology, a compliance mess. Cheap banks are often cheap for a reason. Read that again. The purchase price is the cover charge. The real bill comes later. Which brings us to the section nobody budgets for. The hidden infrastructure of actually running the thing. First, compliance. A bank is one of the most heavily regulated businesses on earth, and regulation is not a one-time fee, it's a permanent staff. You need people whose entire job is the Bank Secrecy Act and anti-money laundering rules, people who file suspicious activity reports, people who make sure you're following the Community Reinvestment Act, consumer protection laws, fair lending laws, and on and on. A small bank can easily spend hundreds of thousands to a few $1,000,000 a year just on compliance staff, software, and audits. Studies by industry groups like the Independent Community Bankers of America have long pegged compliance as one of the single heaviest fixed burdens on small banks, eating a real slice of total operating costs before you've made a dime of profit. Second, technology. And this is the one that shocks people. A bank runs on something called a core banking system, the central software that tracks every account, every balance, every transaction. Most small banks don't build this. They rent it from a handful of vendors, companies like Fiserv, FIS, and Jack Henry, which quietly power a huge chunk of American community banks. Those contracts run into the hundreds of thousands or millions per year, they lock you in for years, and on top of that you're paying for online banking, mobile apps, fraud monitoring, and cybersecurity. Because a bank is now, functionally, a software company that happens to hold money. And the customers expect an app as good as the one the trillion-dollar bank has. Third, deposit insurance. Remember the FDIC, the agency that insures deposits up to $250,000 per depositor? That insurance isn't free to you. Every insured bank pays premiums into the deposit insurance fund, quarterly, based on the size and riskiness of the bank. It's a real, recurring cost, and if you take on more risk, your premium goes up. You are, in effect, paying protection money to the one entity that can shut you down. And it's worth every penny, because it's the reason your depositors trust you at all. Fourth, the physical and human infrastructure. Branches, vaults, security, ATMs, and the single biggest line item of all, people. Loan officers, tellers, a chief financial officer, a chief risk officer, a chief compliance officer. Salaries and benefits are almost always a bank's largest operating expense, full stop. And every branch is a lease or a mortgage, plus insurance, plus utilities, plus armored car cash runs. So far so good, except we've now spent tens of millions of dollars and hired an army, and I still haven't told you how the money actually comes in. So let's slow way down, because this next part is the whole game. This is the thing that, once you see it, you can never unsee. Here's where it gets interesting. You'd think a bank makes money by having money. It doesn't. A bank makes money by owing money. When you deposit $1,000 into your checking account, in your head that's your money, sitting safely in a drawer with your name on it. On the bank's books, that $1,000 is a liability. A debt. The bank owes it back to you, on demand, whenever you ask. Your deposit is not the bank's treasure. It's the bank's IOU. So what does the bank do with it? It doesn't leave it in the drawer. It lends it out as a mortgage, a car loan, a business line of credit. And that loan? That's the bank's asset. Because now someone owes the bank money with interest. Let that land for a moment. The thing you think of as the bank's wealth, your deposits, is actually its debt. And the thing you think of as the bank giving money away, the loans, is actually where it holds its wealth. The whole institution is built backwards from how you picture it. Now, here's the mechanism that makes it all work, and it has a boring name, the net interest margin, or the spread. The bank pays you almost nothing on your checking deposit, maybe 0%, maybe 0.5%. Then it takes that same money and lends it out at 6, 7, 8%. The gap between what it pays for money and what it earns on money, that spread, is the core engine of the entire business. Across the U.S. banking system, that net interest margin tends to hover around 3%, according to FDIC data. 3%. That sounds tiny. And it is. Which is exactly why the second half of the mechanism matters even more, leverage. A bank operates on a sliver of its own money and a mountain of other people's. Regulators, under an international framework called Basel III, require banks to hold a minimum cushion of their own capital against their assets, but that minimum is thin. In practice, a bank might have somewhere around $10 of its own equity supporting $100 of assets. It's roughly 10-to-1 leveraged. Sometimes more. Now put the two halves together. A 3% spread sounds pathetic. But earn 3% on $100 of assets that you only put $10 of your own money behind, and suddenly you're earning $3 on your 10, a 30% return on your actual investment. That's not a savings account. That's a leveraged bet on a thin margin, repeated across every loan you make. That's the aha. A bank is a machine for taking a tiny, boring spread and multiplying it with leverage until it becomes a real return. Which also means, and hold this thought, because it's the whole back half of the story, that same leverage works in reverse. If your assets lose even a small percentage of their value, that thin $10 cushion vanishes, and the bank is insolvent. The leverage that makes the good years great makes the bad years fatal. So that's the core. Now let's stack up how the money actually arrives, because it comes in layers. The first and biggest layer is net interest income, that spread we just talked about, the difference between what the bank earns on loans and securities and what it pays out on deposits. For a typical community bank, this is the majority of all revenue. The second layer is fee income on deposits and accounts, overdraft fees, monthly maintenance fees, ATM fees, wire transfer fees. The small stuff that quietly adds up across thousands of accounts. The third layer is fee income from services, the money a bank makes originating a mortgage and then selling it off, or the fees from treasury services for business clients, wealth management, or safe deposit boxes. Money earned for doing something, rather than for lending something. And the fourth layer is income from the bank's own investment portfolio. A bank never lends out every dollar of deposits. A big chunk gets parked in supposedly safe, liquid investments, most classically, U.S. Treasury bonds and government-backed mortgage securities, which earn interest and can be sold quickly if the bank needs cash. Remember that fourth layer. It looks like the safest one on the list. It is the one that's going to kill the bank in our case study. Now let's talk about the bleed. The operating costs that go out the door every single month whether you make a good loan or not. Bankers have a single number they obsess over for this, the efficiency ratio. It's just the bank's operating expenses divided by its revenue. If a bank has a 60% efficiency ratio, it's spending 60 cents to earn every dollar. Lower is better. A well-run community bank tries to keep it under 60. When it drifts toward 70 or 80, the bank is drowning in its own overhead. And what's in that overhead? Salaries and benefits first, always. Often half or more of all non-interest expense. Then occupancy, the branches, the leases, the utilities, the vault maintenance. Then technology, that core system contract we talked about, plus cybersecurity and the app. Then the FDIC insurance premiums. Then professional fees, the auditors, the lawyers, the consultants. And then there's a cost unique to banking, one that isn't a bill you pay but a wound you absorb, the loan loss provision. Every quarter, a bank has to set aside money to cover loans it expects will go bad. That set-aside comes straight out of earnings. In good times it's small. In a recession, when borrowers stop paying, that provision explodes, and it can turn a profitable bank into a money-losing one in a single quarter without a single new expense being added. The bleed isn't just the lights and the salaries. It's the slow acknowledgement that some of your assets, your precious loans, are quietly turning to dust. Which brings us to risk. Because a bank has a very particular way of dying, and it's not the way you'd guess. It's not the masked robber. Robberies are a rounding error. The thing that kills banks is a mismatch, a structural crack built into the very design of the business. Here it is. A bank borrows short and lends long. Your deposits can be withdrawn tomorrow. That's short-term money. But the 30-year mortgage the bank made with that money can't be called back for 30 years. That's long-term money. So the bank is always, permanently, promising to give people their money back faster than it can get its own money back. In calm times, this is fine, because not everyone withdraws at once. But it's a fault line running under the whole foundation. Now add interest rate risk on top. When interest rates rise, the value of the bank's existing long-term bonds and loans, the ones locked in at yesterday's lower rates, goes down. That's just how bonds work. When new bonds pay more, your old low-paying bond is worth less. So a bank sitting on a big pile of long-term bonds can watch the market value of its safest-looking assets quietly shrink as rates climb. On paper, it might still look fine, until the day it's forced to actually sell those bonds. Then the paper loss becomes a real loss. And remember the leverage. A real loss on the asset side eats straight into that thin capital cushion. And the final risk, the one that ties it all together, is the oldest one in banking, the run. Confidence is the only thing holding the whole structure up. The moment enough depositors believe the bank is in trouble, they all rush to pull their money at once, the short-term money the bank promised to return on demand, and the bank has to sell its long-term assets at a loss to raise cash, which creates the very losses everyone feared, which confirms the panic. A bank run is a self-fulfilling prophecy made of pure psychology. And in the age of smartphones, that prophecy can now fulfill itself in hours. Which is the perfect moment to tell you a true story. Let me tell you about Silicon Valley Bank. Silicon Valley Bank, SVB, was founded in 1983, reportedly over a poker game, with a simple, brilliant idea: be the bank for the tech industry that no traditional bank understood. And for 40 years, it worked beautifully. SVB became the bank for startups and venture capital. If you were a tech founder or a VC fund in California, you banked at SVB. It was woven into the entire ecosystem. Then came the boom. During the pandemic tech surge of 2020 and 2021, money poured into startups, and those startups parked their cash, billions and billions of it, at Silicon Valley Bank. The bank's deposits roughly tripled in a couple of years, ballooning to nearly $200 billion in assets. This looked like a triumph. Deposits are the raw material, remember. SVB suddenly had a mountain of it. But here's the trap, and it's every trap we've talked about, all at once. SVB couldn't lend all that money out fast enough. There weren't enough good loans to make. So it did the safe thing. It poured tens of billions into that fourth layer, the investment portfolio, long-term U.S. Treasury bonds and government-backed mortgage securities. The safest assets in the world, in terms of getting paid back. But long-term, locked in at the rock-bottom interest rates of 2021. Then, in 2022, the Federal Reserve, the U.S. central bank, began raising interest rates faster than it had in decades, fighting inflation. And every one of those long-term bonds SVB had bought at low rates began to lose market value. By late 2022 and early 2023, SVB was sitting on massive unrealized losses on its bond portfolio, losses that existed on paper but hadn't been realized because it hadn't sold anything. According to the bank's own disclosures and the FDIC, these paper losses had grown large enough to threaten the bank's entire capital cushion if they ever had to be sold. And then the two risks collided. SVB's customers were startups, and by early 2023 startups were burning cash and pulling deposits to survive. To meet those withdrawals, SVB was forced to sell some of its bonds, at a loss. On March 8, 2023, it announced it had sold a chunk of its portfolio at a roughly $2 billion loss and needed to raise more capital. That announcement was the record scratch. The venture capital community, a tight, hyper-connected group that talks constantly, read the news and did the math, and the word went out, get your money out. And because these were sophisticated clients with mobile banking, they didn't line up on the sidewalk. They tapped their phones. On March 9th, depositors tried to withdraw about $42 billion in a single day. The next morning, March 10, 2023, regulators shut it down. Silicon Valley Bank, 40 years old, roughly $200 billion in assets, was gone, the second largest bank failure in U.S. history at the time. Here's the lesson, and it's brutal in its simplicity. SVB was not brought down by fraud, or by reckless loans, or by a robbery. It was brought down by U.S. Treasury bonds, the safest asset on the planet, combined with interest rate risk and a duration mismatch, lit on fire by a modern, instant bank run. Every single mechanism we described, textbook, in real life, in 48 hours. The boring risk. The quiet one. The one nobody budgets for. So if the interest spread is this dangerous, why does anyone want to own a bank at all? Now, here's where the sophisticated money plays a different game entirely. Because the people who own banks, well, aren't really playing for that 3% spread. They're playing for return on equity, that leverage multiplier we talked about. A well-run community bank can generate a return on equity in the low to mid-teens, year after year, in a way that's hard to match with almost any ordinary business, precisely because of the leverage that makes it dangerous. Danger and return are the same coin. And there's a second, quieter game, fee income and franchise value. The smartest bank owners chase the layers that don't require taking interest rate risk at all: wealth management fees, treasury services, mortgage origination fees. Steady money that doesn't blow up when rates move. A bank rich in fee income and cheap, sticky deposits, the kind of loyal small depositor who never leaves and never demands high interest, is worth a premium because those deposits are the cheapest raw material in the business. And there's a third game, the one played at the very top, the bank as a piece on a bigger board. Wealthy owners often hold the bank inside a holding company, which gives them flexibility with capital and taxes and lets them use the bank's steady cash flows to fund other things. And the ultimate prize for many small bank owners isn't the annual profit at all. It's the exit, building a solid, well-run community bank and then selling it to a bigger regional bank hungry to enter your market for that healthy multiple of book value. You're not farming the spread. You're building an asset to sell. So it is not really about the interest. It is not even really about the loans. It is about owning a leveraged, regulated, trusted machine, and either compounding its returns quietly for decades or grooming it for sale. Let me put real numbers on it, so you feel both sides of the coin. The good year. Say you own a small community bank with about $300 million in assets and $30 million in your own capital behind it. You earn a healthy net interest margin, keep your efficiency ratio in the mid-50s, and your loan losses are minimal because the economy is humming. You might clear something like $3 to $4 million in net profit for the year. On your $30 million of capital, that's a return north of 10, maybe 12%, while you also built relationships, grew your deposits, and quietly increased the franchise value of the whole thing. The community loves you. The regulators leave you alone. You are, exactly as you dreamed, the house. The bad year. Now the economy turns. Interest rates whip around and squeeze your margin. A recession hits your local business borrowers, and your loan loss provisions triple as loans go bad. Your best, biggest depositors get nervous and start moving money to a bigger bank they think is safer. Your net profit doesn't just shrink, it goes negative. You post a loss of several $1 million, and because you're leveraged 10 to 1, that loss carves directly into your $30 million cushion. The regulators, who left you alone last year, are now in your office every week. And if the losses run deep enough, or the deposits flee fast enough, there is no slow decline. There is just a Friday afternoon, a knock on the door, and the FDIC. That's the two-sided nature of the house. The same leverage that pays you 30% in the sunshine takes everything in the storm. And notice, the good year and the bad year can be the same bank, run the same way, separated only by what interest rates and confidence decide to do. So let's go back to that marble floor. The tall glass doors, the cool, quiet air, your name carved in stone above them. It's still a beautiful picture. But now you know what's really holding it up. It isn't the vault. It isn't the money in the drawer, because there is no drawer. It's a promise, the collective belief of every depositor that they can get their money back whenever they want, a belief that lets you take their short-term IOUs and stretch them into long-term bets, $10 of yours behind $100 of theirs, all resting on a spread so thin you could barely feel it. The marble is just marble. The money is just the product moving through. What you're really buying, and what you're really risking, is trust, leverage to the edge, and only ever as solid as the confidence of the person standing at the counter. The vault isn't really the business. The trust is.